On Thursday, January 8, 2026, the president announced a plan to push $200 billion into mortgage bonds using the power of the government-backed housing giants Fannie Mae and Freddie Mac, with one clear goal: force mortgage rates down. And if your brain just went, wait, isn't that basically printing money? Good, because that question is the whole video. Today we're going to break this down like a crime scene. What exactly is this $200 billion mortgage pump? Is this a rescue or a panic move? Does it actually stop a housing crash, or does it accidentally create the next one? And most importantly, who wins, who loses, and what signals tell you the truth before the headlines do? Lock the door, because the answer isn't in political theater, it's in the plumbing. Ladies and gentlemen, welcome back. This is not financial advice, this is forensic analysis. And tonight we're talking about something most people don't understand until it's too late. How the housing market gets saved on paper, while real people get crushed in reality. Because the housing market isn't just houses. It's the foundation of consumer confidence. It's collateral for the banking system. It's the largest asset most families will ever own. And it's where policymakers go when they need a lever big enough to move an empire. And a $200 billion lever? That's not subtle. That's a flare in the night. What just happened? The event. 1. The announcement: buy mortgage bonds. Let's get the facts on the table. The plan, as reported by major outlets, is use the government-sponsored housing firms, Fannie Mae and Freddie Mac, to purchase $200 billion in mortgage-backed securities to help bring mortgage rates down. And the detail that matters: this is being framed as doable without Congress, because it's routed through those entities' resources and their role in the mortgage market. Now pause. Because most people hear mortgage bonds and their eyes glaze over. But here's the translation in human language. Mortgage-backed securities are basically the financial pipeline that turns your 30-year mortgage into a tradable product that investors buy. When someone powerful steps in and says, we're going to buy $200 billion worth of that pipeline, they're doing one thing. They're trying to raise prices of mortgage bonds, which pushes yields down, which helps push mortgage rates down. And in a housing market where affordability is already a crisis, even a small drop in rates can change monthly payments, demand, and psychology. 2. The timing. Why this week? Why now? Look at what mortgage rates are sitting at right now. Freddie Mac's weekly data had the average 30-year fixed mortgage rate at 6.16% as of January 8, 2026. That's down from roughly 6.93% a year earlier. So yes, rates improved. But here's the catch. Even if rates drift down, home prices are still high, inventory is still tight, and a lot of buyers are still locked out. Multiple reports describe the market as still tough, affordability strained, buyers sidelined, uncertainty hanging over the decision to buy or sell. So in this environment, $200 billion is not a nice idea. It's a statement: we do not want housing to roll over. Because if housing rolls over, it doesn't roll alone. It drags confidence, spending, banking risk, and politics with it. Is this printing the real mechanism? I'm going to say something that will keep you intellectually honest. This plan is not identical to the Federal Reserve printing money, but it can still behave like a quasi-stimulus in the mortgage market, depending on how it's executed and financed. So let's define terms. 1. What printing actually means. When most people say printing, they mean one of two things. The central bank creates reserves and buys assets, classic quantitative easing. The government runs deficits and the system monetizes it indirectly. In the pandemic era, the Federal Reserve famously bought enormous amounts of Treasury securities and mortgage-backed securities, directly affecting yields and spreads. But here, the reporting describes a plan routed through Fannie and Freddie, confirmed by the Housing Finance Regulator's director, and framed as a way to lower mortgage rates, echoing the feel of past Fed-era mortgage bond buying, even if the buyer is different. So it's not the Fed doing quantitative easing in the clean textbook way. But it can still be government-directed balance sheet force, a price support operation, a mortgage spread compression attempt. And those three can look like money printing from the street level because the result can be similar. Rates get pushed down by a giant buyer that doesn't care about normal market pricing. 2. How mortgage rates actually get set, the plumbing. If you understand this, you'll never be fooled by shallow headlines again. Your mortgage rate is basically built from the 10-year Treasury yield, the baseline risk-free reference, plus the mortgage bond yield, which depends on prepayment risk, credit risk, liquidity, plus the primary-secondary spread, what lenders add for overhead, hedging, margin, plus guarantee fees and servicing economics. The 10-year yield matters because it's the gravitational field, but mortgage-backed securities spreads matter because that's where the pain hides. So what does a $200 billion buyer do? They add demand for mortgage bonds, Bond prices rise, yields fall, spreads compress, lenders can often offer lower rates. That's the entire game, and that's why experts are debating the impact. Some estimates sound small, measured in basis points. Others suggest it could be more noticeable. 3. The 200 billion question. Big headline? What real effect? This is where people get tricked. $200 billion is a huge number in normal life, but mortgage markets are enormous and deep. That's why you're seeing analysts quoted saying it might only shave something like 10 to 15 basis points, which is real, but not magical. Meanwhile, another cited estimate, attributed to Redfin's economist in coverage of the announcement, suggested a larger potential range, something like 0.25 to 0.5 percentage points, while still warning it wouldn't solve the underlying supply shortage problem. So what's the truth? Here's the honest answer. It depends on execution, timing, pace, what coupons they buy, whether they target specific maturities, and whether the market front-runs it. But either way, the intent is unmistakable. Artificially increase mortgage bond demand to push borrowing costs down. That's the pump. Why this can be a housing crash defense. Now let's talk motive. Why would policymakers want mortgage rates lower right now, even if it only moves the needle a little? Because the housing market has a special ability to freeze. 1. The lock-in effect, the invisible cage. One of the biggest problems in housing the last few years has been what people call the lock-in effect. Homeowners who locked in very low mortgage rates don't want to sell and take a much higher rate on a new home. That reduces listings, keeps supply tight, and makes the market feel like a museum. Prices don't crash because nothing moves. And when supply stays tight, affordability stays brutal, especially for first-time buyers. Even with mortgage rates easing versus last year, reporting still describes many prospective buyers sidelined by high prices and uncertainty. So if you can push rates down even a bit, you might loosen the lock-in effect, increase transaction support prices, keep construction and related spending from collapsing. That's the soft landing narrative. 2. The psychological lever. Housing runs on confidence. Housing is not a normal market. It's a confidence machine. If people believe rates are falling, they rush to buy before prices rise. If people believe prices are falling, they hesitate. And the hesitating spreads like a virus. A program like this can be designed to send one message: we will not allow a disorderly slide. That alone can change behavior. Or, is this a print your way out gamble? Now we go to the darker interpretation, because there's another reading here, and it's the one you titled the video around. Is this the United States trying to buy time by pumping the mortgage market? 1. The uncomfortable question: if things were fine, why pull this lever? Governments don't deploy $200 billion market operations because they're bored. They do it because something is fragile. And fragility in housing can come from affordability, breaking delinquencies, creeping forced selling beginning at the margins, regional downturns, spreading credit availability, tightening investor demand, evaporating banks, quietly getting more conservative. Even if the headlines say stable, the plumbing might be whispering risk. 2. The who pays question, Fannie, Freddie, and the balance sheet reality. Here's a key detail from reporting that should make you pay attention. The announcement references Fannie Mae and Freddie Mac having large resources, cash reserves, or liquidity, but there are nuances about what that liquidity actually is. One report notes that their combined cash and cash equivalents as of late September were much smaller than the nearly $100 billion each liquidity figure being cited, because that larger figure can include other assets, not just literal cash. Translation? Depending on structure, this could mean selling assets, reallocating portfolios, taking on duration risk, increasing exposure to mortgage credit volatility, reducing buffers meant for future stress. And critics have already raised a concern in coverage. Draining reserves could make the housing finance system more vulnerable if a downturn hits. So yes, this might lower mortgage rates, but it can also shift risk around the system. 3. The moral hazard: save prices versus fix affordability. This is the part nobody likes to say out loud. Lower mortgage rates can make homes more affordable in the short term, but they can also restart bidding wars and push prices higher if supply is still tight. So the question becomes, are we making housing cheaper, or are we just making housing liquid again, while keeping the same structural shortage? Even coverage that discusses rate impact includes warnings. Affordability is also about home supply, not just rates. That's why this could be a pump and not a cure. The 3 outcomes. Now I'm going to give you the 3 timelines, and whichever one plays out, you'll understand the move. Outcome 1. Soft landing stabilizer. Mortgage rates ease a little, transaction volume improves, builders get breathing room. Price declines are mild, confidence returns slowly. Policymakers declare victory. This is the best case narrative, and it's exactly why officials like this lever. It buys time. Outcome 2. Price support. That reinflates the problem. Rates dip. Demand jumps. Prices rise again. First-time buyers get crushed again. Affordability worsens. Inequality deepens. Political backlash grows. The next correction becomes even uglier. In other words, you didn't fix housing. You just reset the pain higher. Outcome 3. The pump fails. This is the scary one. If the underlying problem is bigger than rates, if jobs weaken, credit tightens, delinquencies rise, $200 billion of bond buying might be a bandage on a fracture. Even Reuters-cited skepticism suggests limited rate effects. So in this outcome, rates don't drop enough buyers, still can't afford sellers, still won't list activity, stays frozen, and if a shock hits, you get forced selling anyway. That's when the public realizes the lever wasn't a solution, it was a signal. What to watch? The truth metrics. If you want to know whether this $200 billion pump is working or whether it's just optics, watch these. 1. The weekly mortgage rate print. Start with the simple one. Freddie Mac's weekly series is a clean benchmark. It had the 30-year fixed at 6.16% on January 8, 2026. If this program is real and meaningful, you should see sustained pressure downward, not just a one-week wiggle. 2. The 10-year Treasury yield versus mortgage rates. If the 10-year yield rises and mortgage rates refuse to fall, the program is losing the fight. If the 10-year yield stays stable but mortgage rates drop, that's spread compression, exactly what bond buying targets. 3. Mortgage-backed securities, spreads. This is the real battlefield. The plan's entire purpose is to compress spreads by adding demand. If spreads don't move, the pump is mostly theater. 4. Housing inventory and new listings. If rates fall but inventory doesn't rise, affordability doesn't truly improve. You just created more demand chasing the same supply. 5. Monthly payment realities. One AP report noted median monthly payment improvements year over year, but still described buyers sidelined due to prices and uncertainty. That's the point. The payment is the pain. If payments aren't coming down enough to change behavior, nothing changes. 6. The details. FHFA refuses to give you up front. The regulator's director confirmed seriousness, but did not give full details right away in reporting. That means the structure matters. How fast do they buy? Which coupons? Which maturities? Do they buy in the open market or through specified channels? Do they crowd out private investors? Do they create distortions? The market will sniff that out fast. So let's bring it home. A $200 billion mortgage bond buying plan isn't just helping affordability, it's a message. It says, housing is too important to let it fall on its own, and whether you call it printing or not, the effect is the same kind of move. A top-down intervention designed to push borrowing costs down and stabilize psychology. But here's the line that matters most. If the core issue is supply, wages, and affordability, then cheaper debt isn't a cure. It's a delay. It buys time, it changes who survives, and it quietly tells you what policymakers fear. Because nobody fires a $200 billion cannon at the mortgage market unless they see smoke. And the moment you accept that, you stop watching the headlines, and you start watching the plumbing.